David and Chris grew up on the same street in Columbus, Ohio. They went to the same high school. They both got jobs in their mid-20s. They both made around $60,000 a year. They both had the same dream: to build something real, something lasting, something they could be proud of when they were old. At 31, Chris bought a house. 4 bedrooms, 2-car garage, a yard big enough for the kids he planned to have. The mortgage was $1,800 a month. His parents cried at the closing. His grandmother called it the American dream. David rented an apartment. $800 a month. 2 bedrooms. No yard. His parents worried about him. His uncle told him he was throwing money away. His coworkers asked when he was going to grow up and buy something. 20 years later, David retired at 58 with $1.4 million. Chris is still working. He has to be. This is not a story about who was smarter. This is a story about a lie so deeply buried in American culture that most people never question it. And by the time they do, it is too late to change the math. Let me show you what actually happened. When Chris bought that house in Columbus in 2005, he put $60,000 down. That was his savings, every dollar he had. He felt proud. He felt like a real adult. What he did not feel, because no one told him, was the weight of what he had just committed to. That $60,000 was gone from his investment life the moment it hit the closing table. According to the Federal Reserve Survey of Consumer Finances, the median American homeowner keeps the majority of their net worth locked inside their home. Locked. Not growing at market rates. Not liquid. Locked. But David took that same $60,000 and put it in a low-cost index fund. He did not touch it. He added $500 a month to it. The same $500 Chris was spending every month on property taxes, maintenance, fees, and home insurance on top of his mortgage. According to Vanguard's How America Saves report, a diversified index portfolio has historically returned an average of 7 to 10% annually over a 30-year period. David's $60,000 investment, plus $500 a month for 20 years, grew to over $1.4 million. Chris's home, during that same period, appreciated from $300,000 to roughly $580,000. On paper, that looks like a gain. But subtract the original down payment. Subtract 20 years of mortgage interest, which according to the CFPB totals more than the purchase price on a 30-year loan. Subtract property taxes. Subtract repairs. Subtract 2 roof replacements. Subtract the kitchen remodel he had to do to keep the value up. The Joint Center for Housing Studies at Harvard University found that homeowners spend 1 to 3% of their home's value every single year on maintenance alone. On a $300,000 home, that is $3,000 to $9,000 a year. Over 20 years, that is between $60,000 and $180,000, just to keep the house standing. When Chris did the real math, he had not built wealth. He had paid for the privilege of maintaining an asset he could not spend. Now I want you to stop for a second, because I know what you are thinking. You are thinking, but what about equity? What about building something to pass down? What about the stability? What about the fact that rent keeps going up? Those are real questions, and the answers are more complicated than what your uncle told you at Thanksgiving. Equity is real, but equity is not free. According to the National Association of Realtors, the average American sells their home every 8 years. Every time you sell, you pay 6% in real estate commissions. You pay closing costs. You pay capital gains taxes if you have not lived there long enough. The equity you built often goes right back out the door. Rent increases are real too. But here is what the Bureau of Labor Statistics data shows. Rental increases in most U.S. markets have tracked close to inflation, averaging around 3% annually over the past 2 decades. Meanwhile, home prices in markets like Phoenix, Austin, and Miami have swung wildly, up 40% in 2 years, then down 20%. Volatility cuts both ways. David did face rent increases. He moved twice in 20 years. But he stayed flexible. When a cheaper, better apartment opened up near his office, he took it. When his company relocated, he relocated. He never had a house chaining him to a zip code. Chris turned down a job offer in Seattle in 2012. The offer would have paid 30% more. He said no because he could not afford to sell at that moment. The market was still recovering from 2008. That decision alone, compounded over 10 years, likely cost him more than $200,000 in lifetime earnings. This is the part no one talks about. The invisible cost of being stuck. According to research from Glassdoor and the Bureau of Labor Statistics, workers who change cities for better opportunities earn on average 18 to 20% more over their careers than those who stay in one market. Homeownership, for many people, is not just a financial decision. It is a geographic trap. David understood this, not because he was anti-homeownership, but because he ran the numbers honestly at 31. He asked himself, what is this house actually costing me? Not just the mortgage, the opportunity cost of the down payment, the mobility I am giving up, the repairs and taxes and insurance, the risk that the market dips right before I need to sell. He decided renting made more sense for his life. He invested the difference, and he did it consistently, quietly, for 2 decades, while everyone around him told him he was making a mistake. Now let me be clear about something. Homeownership is not always the wrong choice. For some people, in some markets, at some times in their lives, buying a home is the smartest financial move they can make. If you buy in a growing market, stay for 15 or more years, lock in a low fixed rate, and keep your maintenance costs controlled, buying can absolutely build real wealth. The point is not that renting always wins. The point is that buying does not always win. And in America, we have been told for generations that buying always wins, that renting is waste, that a house is the foundation of everything. Fidelity Investments published research showing that Americans who maximize tax-advantaged accounts, 401k, IRA, Roth IRA, before buying a home consistently retire with more than those who buy first and invest later. The order matters. The tax advantages of investing early are enormous. Time in the market is not replaceable. David maxed his Roth IRA every year from age 28. He contributed enough to his 401k to get his full employer match every year. He invested the difference between what he paid in rent and what Chris paid in total housing costs. He did not do anything exotic. No cryptocurrency. No single stocks. No real estate investment schemes. Index funds and time. That is the whole story. At 58, David retired. He moved to Asheville, North Carolina. He bought a small house, paid for in cash, from a fraction of his portfolio. He has no mortgage. He has no debt. He has monthly investment income that covers his life. Chris is 53. He still has 9 years left on his mortgage. His retirement account has around $340,000 in it, less than a quarter of what David built. He is not broke. He is not a failure. But he will not retire at 58. He will probably work until 67. Because that is when Social Security kicks in at full benefit and he needs every dollar of it. 2 people. Same street. Same income. Same starting point. The difference was not talent. It was not luck. It was one assumption. That buying was always the smart move, and whether you questioned it. Here is what you need to do right now. First, calculate your real cost of ownership. Not just your mortgage. Add property taxes, insurance, maintenance at 1% of value per year, HO if applicable, and the opportunity cost of your down payment invested at 7% annually. That is your real number. Second, calculate your real cost of renting. Your monthly rent, plus the growth of the money you are not tying up in a down payment, plus the mobility premium. What is your geographic freedom actually worth to your career? Third, If you own a home already, that is not a mistake. It might be the right choice for you, but maximize your 401k and Roth IRA contributions before you make extra mortgage payments. According to Fidelity, the tax advantage of a maxed Roth IRA over 20 years beats the interest savings of most extra mortgage payments. Fourth, if you are renting right now and feeling shame about it, stop. Open a brokerage account today. Set up an automatic transfer. Invest the difference between your rent and what a comparable mortgage would cost. Do it every month without fail. Let David's story show you what that discipline builds. David did not retire richer because he was anti-American. He retired richer because he refused to let a cultural story do his math for him. The question is not whether you own or rent. The question is whether you are building wealth or just building the appearance of wealth while the real money walks out the door in property taxes, maintenance bills, and lost investment years. David asked that question at 31. Chris never did. Which one are you going to be?